Number of jobs right now, employment is off by about 10 million from where we started, but we're well below that 15% level of unemployment. We've cut that almost in half since the economy reopened. We look in terms of interest rates. These are Treasury yields. This is a consensus forecast. This is the street forecast. The Fed does not put forecast on Treasury yield projections. You can see this is where current market was when I ran this slide last week. If we look at the short end of the curve, like the 2-year Treasury, expecting that to end at fourth quarter at 19 basis points. And if we look through 21, maybe moving as high as 37 basis points. The short end of the yield curve is going to be anchored by what the Fed expectations are. And the Fed expectations are that we're not going to see any rate hikes for 2021, 2022, and probably 2023. And I'll point to that here in a little bit more detail in a second. But you can also see that the 10-year Treasury currently yields about 78 basis points and is projected to gradually increase over time. But important takeaways here is, we're earning 10 basis points on cash right now as an institution. So cash is basically a non-earning asset. And a lot of our clients are dealing with, deposit inflows and trying to figure out what to do with their cash right now. So I mentioned the expectation for the Fed funds rate. This is the Fed's dot plots. So each yellow dot represents one Fed member's forecast for the Fed funds rate. This is 2020, 21, 22, and 23. This is released on a quarterly basis, and you can see here's each member of the Fed. They also include here the H means hawkish, the N means neutral, and then the D is dovish, and then the MD is mildly dovish. But as you can see, it was important in September, they released for the Fed, for the first time released their forecast for 2023. And they signaled that all the way through 23, we're not expecting the Fed funds rate to change. So again, if we have a lot of cash on our balance sheet, we're not expecting to see that cash earning any more all the way through 2023. So we're talking basically 3+ years from now. I'm going to talk, again about a little bit more about monetary policy. The Fed came in, they basically decreased rates down to 0. The other thing that they've done is they've gone in and they started to use their balance sheet to buy mortgage-backed securities and treasuries. They did this the last cycle following the financial crisis, and you can see the first QEs are shown up here. They were from November of 08, March 09 was QE1. And then we had March 09 to June of 2010. Those combined for about $1.25 trillion of mortgage-backed security purchases. This is a graph showing those purchases. The blue line corresponds to the left axis, and then the red line shows the percentage of Fed purchases as a percentage of the total agency issuance. But what you'll notice is $1.25 trillion was spent over about an 18-month time period from November of 08 to June of 2010. During this current quantitative easing from March to where we currently are, they've already bought $1.1 trillion of mortgage-backed securities. And so when we had the lockdowns and we saw a lot of the markets were basically in disarray back in March, the dislocation caused the Fed to step in and buy mortgage-backed securities very aggressively. You can see they came in and they were buying monthly $250 to $300 billion in mortgage-backed securities. The reason they were doing that, they're trying to push mortgage rates low. What that allows consumers to do is to go out and refinance their mortgages, have more money to spend, and stimulate the economy. So the Fed has, in a big way, they've dropped rates to 0, but they're also using their balance sheet in unprecedented manner to try to get the markets back into more of a normal state. So what have we seen on the fiscal stimulus side? We've seen the CARES Act that we had come into play, about a $1.8 trillion package. What's that happened to financial institutions? We've seen a huge amount of deposits come into institutions. U.S. banks saw almost $2 trillion of cash inflow during a 10-week span. This is from March 11th to May 20th. We went from $13.5 trillion to $15.4 trillion. So we manage about 22 different balance sheets that we work with, and we've seen it almost on every single balance sheet we work with. The liquidity has just been unbelievable since this all started. Some of the same thing. This is just showing the cash side of things. The deposit surge basically resulted in an increase in cash from about $1.7 trillion up to a peak of about $3.3 trillion. So we saw a huge amount of cash come in. Everyone's like, what do I do with my cash now that I have it? You usually get all this cash when you least want it, when interest rates are low, and that's basically how every cycle has worked. And it hasn't disappointed this go around. So when we step back and we look, how's this going to impact our earnings moving forward? One of the things that I always tell people, the net interest income number on your income statement is the largest number on the income statement. There's basically three levers that you have to change that number. You've got rate, you've got volume, and you've got mix. And one of the challenges that we have right now is that if we look at this orange line, so if we go out to where we were pre-financial crisis, earning asset yields were almost at 7%, as hard as that is to believe. But cost of funds, the yellow line here, which corresponds to the right axis, was about 3.25% back then. So when we had the last financial crisis, financial institutions were able to drop cost of funds by 293 basis points from the peak to the trough. But once we got there, this blue line here, it basically hugged that 50 basis point line, and this is through the end of 2019. And we got up to, pushing about a 1% cost of funds. The problem is, compared to the last time period, we don't have much room to drop cost of funds, but we still have our earning asset yield, pushing roughly 5% that could drop quite a bit further. So what we as an institution have to do, we're probably not going to make it up on rate. We're probably going to have to improve margins by changing mix or increasing the size of our balance sheet. So basically, I went through a couple different scenarios just to show, what are some things that institutions could be doing right now. This is actually a tear-off page from the Federal Home Loan Bank. It was basically showing what you could do with the commercial real estate loan, $1 million commercial real estate loan. The loan structure was a 20-year AM with a 10-year balloon. It was at a rate of 380, and you can see that it was funded with 60% advances and 40% deposits. Here's the 3.8% rate. So 60% was advances. The advance structure was a 20-year AM, 10-year balloon, just like the loan, and that was at a cost of roughly 131. And so when you factor the blended cost versus the asset yield of 380, we were earning a spread of 271 basis points on that transaction. And I will tell you, it's a very well matched transaction. So I took that and I said, all right, so what's this look like if we take it and we layer it onto an existing balance sheet? And this is one of our existing clients. I said, let's take not just $1 million. Let's say we could actually generate a significant amount of loan demand. By significant, this is about a $245 million balance sheet. I layered on $15 million of that 10-year fixed 20-year AM onto their balance sheet. This is their base net interest income profile. They had some exposure to rising rates from an earnings perspective, not much. You can see it only like an up 200, up 300, they were losing 3.8%. So their net interest income was declining from about $10.4 million to roughly $10 million, so about $400,000 drop in up 300. So I just took their existing profile, I grew the size of their balance sheet by $15 million at that 380, the same blend that they had in the example, the Federal Home Loan Bank had an example, but I'm blending in $15 million. So I was able to put $15 million in the base case income. That interest income would increase from about $10.4 million to about $10.8 million. So we're increasing income by $408,000. We have a little bit more in terms of a percentage change from base. When we look at up 300, we've got more volatility, but you actually, if you look at up 300 from a dollar perspective, we're still better off by about $317,000. And as someone once told me, you don't spend ratios, you spend dollars. And so that even though the ratio says, or the percentage change says that we have more volatility, the dollars are actually higher than they would have been if we would have done nothing at all. So what this tells me is, you're going to be able to make, quite a bit more money just from an income simulation perspective with this strategy. The other strategy that this institution could consider was just using cash that was on their balance sheet. This institution actually had about $15 million in cash. And if we wanted to just take the interest rate risk, just put the asset and fund it with cash, you can see that the earnings go up, base case earnings go up to about $10.9 million. You're increasing income by about $550,000. But if we look at the uprate scenarios, if we go to up 300, we're generating $138,000 more than base, but we've got more volatility. We're decreasing from base by about 7.4%. But again, we still have more dollars than our base case scenario. So we're still doing better off there. And part of it's the 380 that we're earning on the asset versus the 10 basis points we're earning on cash. Even 300, you're still 70 basis points better off than cash right now, which just shows that potential impact. But there's two sides of this. There's income simulation, and then there's the Eve piece of it. The one thing I will tell you, whenever you're doing any kind of strategy where you're taking down fixed rate advances or those type of things, is make sure that you have some protection on the asset side from a prepayment penalty perspective. Like if you think about it, let's say a year ago, if we would have gone out and taken this advance structure down, and it would have been much more expensive then, this asset may be gone because interest rates have moved so much lower in the last year. All of a sudden, you don't have the asset, but you've got the liability on your books. So that's one of the risks that you have to guard against when looking at these strategies, to make sure that you have prepayment penalties in place. Probably not as big of an issue right now because rates are lower. If you got stuck with the liability, it wouldn't be as onerous, but it's still, when the asset goes away and you're sitting in cash again, then you've got another issue. But from an Eve perspective, again, here's the base profile. This bank actually sees their balance sheet appreciate in value in uprate scenarios. And that's because the financial institution has a lot of core deposits on their books. The value of this bank actually appreciates. You can see up 300, their Eve ratio increases from about 12.9% to 16.8%, and their Eve dollar amount goes from $34.5 million to $42.9 million. And then here's the transaction we layered on with using the advances, a blend of the advances and the money market account. You can see this really does not change their profile very much at all. It's very similar. If you look at the Eve ratio, the dollar change, don't quite get as much of an increase in Eve and the uprate scenarios, but what this basically says is a pretty well matched from a duration perspective simulation. And then here's the scenario where I just used cash, and you can see this is where it's going to have the biggest impact to your Eve. You can see in up 300, Eve appreciates by about $5.4 million versus about 7.8. So you're trimming off about $2.3 million of Eve appreciation in the uprate scenarios by doing this. One of the things that you could consider with the cash strategy is you start to book some of the loans, and you decide, you know what, I do need some funding right now, but I'm just going to fund them short for right now, but I'm going to take a forward starting advance down right now, meaning that I'm going to continue to borrow short term, but 1 year from now, I'm going to have an advance in place for a 2-year term at 1.25%. So I'm going to take some liability duration down, but I'm not going to take it down now because I know the Fed has told me that rates are going to remain at zero or near zero through the end of 2023. So there's some other strategies on top of this with forward settling advances and those type of things that can be looked at in conjunction. So these are the type of strategy you can do and look at. We've got a finite amount of time today, but I'm going to hand it over to Mike. He's going to get into more of using cash to invest in securities.
Thanks, Chuck. Appreciate that. So, our preference is definitely for our clients to make loans, much better yielding instruments than having to go out and buy securities. That strategy that Chuck walked through for commercial real estate, that could also work for ag real estate. It could also work for 1 to 4 family, maybe not as much, spread in 1 to 4 family. But that's our preference in working with accounts is that they, make the loans because there's certainly more income and more net interest income that they can generate from that. So the alternative here is kind of investments. If those, loans don't exist in your operating market, then to get fully invested comes back to the investment portfolio. So, one of the things that's happened with the investment portfolio so far is yields have declined very sharply. Here at December, we were at a 2.45 yield at year end. Kind of at the peak of rates actually occurred about a year earlier, and we started having some declines in rates during 2019. But you can see that the rate in 6 months went from 2.45. This is off of call report information down to a 1.94 rate. And the reason for that would be a couple of things. One would be certainly reinvestment of cash flow or deploying new cash at significantly lower rates than your overall book yield. An institution-owned callable securities, agency callable securities, those were no doubt called. We don't really hardly have any callable exposure in our portfolios. And then the third thing, prepayments, mortgages, which we have a lot of mortgages in our portfolio allocations. And so, depending upon the price that you pay for those mortgages, not only do you have to reinvest your cash flow lower, but if you paid, large premiums and taking large pay downs, that can certainly result in more premium amortization expense and lowering your yield. So, those are all the combinations fly yield throughout. This is in the banking industry, but the same thing has also happened, in the credit union industry as well. So, the securities that we have been using for, 6 months now, going back to, really kind of all year, if you will, is pretty much these sectors. One is tax-exempt municipal securities, if tax-exempt income, benefits your institution. The second is taxable municipal securities. A third sector is mortgage-backed pass-throughs, looking at the jumbo market, 30-year jumbo market. And then another sector is PAC and sequential CMOs, trying to stay down in coupon and collateral. And then another kind of last avenue that we've utilized is also 20-year mortgage-backed. Get a little bit more yield than 15-year, not much additional price risk versus a 15-year. And you have, it's a low pay-up cost versus 30-year, 20-year mortgage-backed trade off of 30-year mortgages. And right now, the pay-up for those is very low as well. So these are kind of the 5 sectors, if you will, that we're kind of going to look at here. So on municipal securities, I think, you have to kind of get some terminology correct here and get an understanding of how the markets work. For tax-exempt issues, bank qualified, what that means is that the issuer is going to issue no more than $10 million a year. So the problem that we're seeing now in the bank qualified market is there's just not as much BQ debt being issued, because if you think about a school going out and building, a new school or renovation, that can easily be more than $10 million, particularly in larger school districts. So one issue that's existing and becoming more of an issue is this $10 million threshold is limiting the amount of bank-qualified municipal securities that are in the market. What's filling that market is what's called this general market. So these instruments, again, are tax exempt, but they're being issued by larger schools, municipalities, counties, states, and the tax treatment is similar to the bank qualified, but there are some differences with something called the TEFRA adjustment, which looks at your cost of funds. And we could probably spend, 30 minutes going through TEFRA and the impact that it has on yield. Unfortunately, we don't have that type of time today. But, general market, there are banks out there that buy general market tax-exempt issues, particularly those that have very low cost of funds and don't experience much cost of funds fluctuation when rates rise. Or something else that has been done in the last, several years is an institution going out and creating a bank subsidiary to own these, to hold these tax-exempt general market issues. And that's a way to avoid TEFRA for a bank, is to create a subsidiary. The other thing that exists in the municipal market, and this is in tax-exempt and taxable market, is how the securities are sold. So you can buy munis one of two ways: as a new issue or as a secondary instrument. Typically, the new issues are going to be cheaper than a secondary issue, particularly when they're a negotiated issue. So negotiated issues, what are these animals? This is where a dealer has bankers employed to go out and call on local municipality issuers, schools, cities, counties, structuring municipal bond issuances for those institutions and bringing them to market. Now, there's a big difference here in negotiated and competitive market. And as an end investor, the difference is usually two things. One is structure of the instrument, and the second is the coupon. Coupon and structure is kind of one and the same, and then the other one is the actual yield that you're receiving from the instrument. The difference in a competitive municipal issuance is that, let's say Johnson County schools, Blue Valley schools are going to go out and they want to issue, $50 million bonds to, build some new schools here. They would go out on a competitive basis and, make this announcement. They'd be working with a muni advisor, and, numerous broker dealers would bid on the issue, and the lowest, interest rate, overall interest cost of the issue is the winner. And so in the competitive market, because it's a bidding process, that's what drives down the yield, and it also results in a different couponing type structure than what you see in the negotiated market. So sometimes you may not know if deals are negotiated or competitive if you're seeing them from a broker. And sometimes brokers will go out and they will buy a negotiated issue, and then they'll just mark up the price from there, and are actually selling the bonds above the price where the bonds came as an issuance. So the taxable issues, which is the other aspect of the muni market, are also sold negotiated, competitive, and clearly the secondary market as well. So just to kind of recap the munis here, negotiated is going to give you the highest yield, probably secondary market then, and then the lowest yielding munis tend to be in the competitive new issue. So certainly there's some issues about municipalities and their revenue flows, with COVID. We've felt very comfortable in investing in school bonds, particularly in school bonds that are in states that have some sort of state aid backing program. And there's 4 different types of state aid backing programs. One is a permanent fund program. Most that you'll see on this is in Texas It's a permanent school fund. It's over a $40 billion endowment that existed from like the 1850s. It, has all sorts of oil and gas and lease revenues in that. Texas bonds are pretty much considered, Texas school bonds are considered probably some of the strongest credits in the country. And again, you're going to find these programs in both tax-exempt and taxable munis. There's no difference in the credit quality structure of a muni, whether it's tax-exempt or taxable. You're looking at the same types of things, the overall debt, and then in the municipality, what's their revenues versus their expenses, what's their tax concentration base. And then you overlay it with these additional credit enhancements. So guarantee programs are also very strong. This is where the state is explicitly guaranteeing the debt issuance. You'll see probably of these issuers, probably the most in Michigan, Washington, and Oregon. Don't see quite as much in Idaho and Utah. These are typically triple and double A rated issues. And all of these issues tend to just trade as kind of generic instruments. They're going to be all the same rating if they have this type of state aid backing. Then you've got a state appropriation program. You're going to see those in Minnesota and South Carolina. Appropriation program is a little different from the state aid intercept, and it's just how the fund flows of state aid could be redirected to pay for any principal and interest that is ever missed by an issuer. So the state aid intercept programs is what you'll see more of in Home Loan Bank District. Colorado is the only state that has a credit enhancement. They have a state aid intercept program. But Missouri, we have, given where we're located here in the Kansas City area, we do a lot in Missouri. You'll also see Ohio, Georgia, Indiana, Arkansas. And all of these issues are AA rated. There's some other state credit enhancement programs out there, like in New Jersey, Pennsylvania. I'm not showing them on here because they tend to be lower rated. So again, we prefer the negotiated new issue market. That's where we buy most of our munis at. They have much higher yields than competitive or secondary, and they have better couponing structures. And that's really important right now. You want bigger coupons. Coupon is one of the drivers to duration, and duration is a driver to price sensitivity. So the larger the coupon you have, the lower the price sensitivity is going to be, everything else being equal. And we feel very comfortable going out up to 20 years if we're getting 3 and 4% coupons backing the deals. So here's an example of a BQ bond that came through a competitive market. It's Crawford County, Georgia, it came through the negotiated market, rated AA1. This is because of the Georgia state intercept program, I believe, that Georgia has. And let's just look at this 2034 issue. This came as a yield to worst, which is to the 2030 call date at a 176 yield with a 3% coupon resulting in a $110 price. On a tax equivalent basis for a sub-S bank using no TAPR adjustment, 29% tax bracket, it comes a 250 yield to the call date. Now, if that bond isn't called in 2030, then for the final 4 years to maturity, you're going to own the instrument at par because you're going to amortize this premium to the call date. And so you're going to have a 3% instrument at par based upon current tax rates that would get to a 426 tax equivalent yield. We're very comfortable in making this type of investment right now. We're not taking any type of prepayment risk. We certainly have some credit risk for sure, but historically that credit risk is low. And then we have an extra layer or credit enhancement from the state credit enhancement program from Georgia. We're comparing it to an Eli, Minnesota school district. Again, Minnesota has a school district enhancement program. Their bonds are all rated AA2. All of Georgia bonds, school bonds, are rated AA1. 2028 call date. But this came through the competitive channels. And so this is where all the dealers submit their levels. And the first thing you're going to see is the couponing structure is completely different. Particularly when you go out the curve, the coupons tend to be like current coupons. They're selling these bonds at par. This bond right here has much higher, has higher interest rate risk than this bond right here because of the difference in couponing structure. And then if you look at the yield going out to the 28 call date, This is a 135 yield that is a 192 tax equivalent yield. So the negotiated new issue is yielding 58 basis points higher yield on a tax equivalent basis. And in 28, if this bond is not called, you're still earning 135. There's no yield coupon kick for the investor here. This is why we prefer the negotiated muni market to competitive. We virtually will not do any competitive deals unless it's just a local deal where one of our clients wants to be involved. So taxable munis, they've always been around. When I managed a portfolio 20 years ago, I owned some taxable munis. So, but we've seen since 2017 a big surge in taxable munis because of change in the tax laws that happened in 2017 regarding refunding issues. And I'm not going to go into the big reasons behind this, but essentially what happened is you can't. It's become much more difficult to refund BQ or general market munis. And so all the refundings that you're seeing right now, and you're seeing a lot of them, are coming in taxable munis. And they're using these taxable munis to essentially refund the tax-exempt debt, whether it's BQ or general market that's out there. So there's been a real big surge of issuance, and particularly, in the last few months, we've seen, every day there's deals coming in states. I think there's like 3 or 4 Texas negotiated PSF bonds coming today that are taxable. For financial institutions, you're probably going to be focused a little bit more inside of 10 years in the taxable market. I don't like going out as far in the taxable market as I do in the tax-exempt market. And the taxable securities, our best value, in our opinion, has been in the 5 to 10 year sector. Again, though, we like the negotiated new issues and taxable munis. They're sold one of two ways, even in the negotiated market. A lot of times they're sold at par, which isn't necessarily my preference, but they're sold at a spread to treasury at par. The other way is they will have some couponing to them. And, I like that couponing again because it's going to lower some duration, lower some price volatility.
Hey, Mike.
Yes.
This is Susan. I'm sorry to interrupt, but I don't think the slides are advancing in the presentation. I'm not sure. Maybe we're stuck on the EVE, NEV slide.
I should be the presenter. I think I was now changed to being the presenter. So.
Got it. Okay.
So we are, apologize for that. We are on slide 19 if you want to move forward to buying municipal taxable securities. Again, this is a negotiated issue that came out last week, and Magnolia, Texas ISD has the PSF backing, AAA rated. And we're just doing a comparison here. We're receiving a 114 yield to the 27 maturity. Agency callables coming at 82 basis points. Obviously, some potential for that to be called. Maybe as it rolls down the curve, perhaps. And then agency bulls at 70 basis points. So this is really why you buy taxable munis: is spread pickup to agencies, avoid mortgage prepayment risk. And if you don't need tax-exempt income. So let's move into mortgage securities here. Obviously, prepayment speeds have been lightning fast and have been causing everyone problems, and we're having to reinvest more. And you see how much mortgage rates have come down. This is the Freddie Mac survey. We're now down to about 2 7/8 on 30-year mortgages, 2 3/8 on 15-year mortgages. So the two things that we're looking at in mortgage-backed securities, one is the overall rate of the loans to the homeowners versus market rates. And the second thing we're looking at is mortgage prepayment speeds from servicers. So those are the two things that are driving prepayment in issues right now. So this is kind of a jumbled up mess here. I just wanted to point out a few things. Obviously, Quicken has a pretty well defined, reputation as being a pretty aggressive, refinancing. And so one of the things that you can do is focus more on bank issuer. They don't tend to be as aggressive in terms of refinancing. But WFHM as Wells Fargo home mortgage, and you can see that they are pretty aggressive in terms of wells. Some of the more slower ones, like PNC Bank, very slow. Caliber, Nation Star, another one is United Shore. So you just need to have an understanding of who the servicer is. What's the largest servicer? How diversified is the servicing mix? You want it to be more diversified. And sometimes you'll see something in these pools that will show servicers less than 1%, all aggregated together will be the largest services. So you always want to know what's the loan rate of to the homeowners of the pool that you're buying, and who's the servicing, what's the servicing mix. The next thing you need to know is an understanding of the prepayment estimates. So Bloomberg median right now, on new low rate collateral, there's very few contributors. A couple of years ago, Bloomberg came out with a more enhanced prepayment model that's known as BAM, and it's a much kind of more robust prepayment model than median speeds. Median speeds is just based upon street dealers providing their speeds. The other way that we look at bonds is these two ways, and then just at various prepayment speeds also. So here's a Bloomberg median speed for a 30-year jumbo, 2%, and you can see there's two contributors. One is BAM, which is Bloomberg's own prepayment model, Bloomberg Agency prepayment model. The only dealer providing speeds under Bloomberg median is Bank of America, Merrill Lynch. So, you just need to be aware of that Bloomberg median probably isn't the best way to look at, assessing prepayment speeds. BAM is a much more robust model, and then just looking at the various prepayment speeds. So 30-year jumbo twos is one of the things that we like in here, but they are very rate sensitive. 600,000 plus is going to be the average loan balance. The reason why we like them is that they trade back from the TBA market, and so they're cheaper. They have been trading back as much as 1 point. I looked here this morning, and an offering today is trading back 1 7/32. So that makes for a much cheaper bond when you can buy something, because the conventional 30-year is going to be trading right at the 30-year price market, whereas a jumbo is going to be trading back almost 1.25 points below that. The average loan rates on these are typically coming somewhere between 280 to 295, so you're kind of right at the current rate. Bankrate.com, 30-year jumbo average mortgage rate throughout the nation right now is about 315, but certainly there's rates lower than that, and some rates higher than that, obviously. So we think there's value in this product, at a low $102 price. The good aspect right now, based on where we are this morning, is they're actually below 102. So here's a Bloomberg median prepayment speed for a 30-year jumbo, 2%. First thing you look at here is a 294 rate. That's the loan rate to the homeowners, and this is a $102.4 price when I ran this screen, which was on October the 9th. Today, like I said, the price is 101.26, so quarter to point or so cheaper, and that's about 6 basis points of additional yield on the Bloomberg median. You can see at slow speed, you're going to have a 10 to 11-year average life out here at slow speed, but it gives you the ability to get around a 150 yield. Here's BAM's prepayment model, same bond, 142 is their prepayment projection, running at about a 20 CPR. You're staying at over a 1% yield through a 30 CPR, and I think that's key. You can allow this thing could heat up, and where is a 293 loan rate going to heat up at? It's going to be at mortgage rates below 250 is where it's going to come at. And are we going to get there on jumbos? I don't know. I think conventionals could get there, but jumbo rates tend to be higher than conventionals. And here it is just on various prepayment speeds. This is something that we look at, just what's the speed of this deal, what's the speed of the underlying collateral. New issuance here on these twos, they haven't existed before this year, so not a lot of prepayment history yet. But again, you can see that this bond holds up quite well, even really through 40 CPR, you're making some positive spread. Again, the alternative here is 10 basis points in cash. So we think that this is, a reasonable risk. But again, I would much rather my accounts, just keep some mortgage loans that they like instead of just buying this, because they're going to be, getting that full, 2 7/8 yield to 3% yield. So the next thing we're looking at is CMOs, and we've been looking at sequentials and PAC structures. Again, looking at underlying low rate collateral, conventional and jumbo loans, focusing more on 2%, 30-year. On the front sequential, we're looking at 30-year 2% collateral, and this is the non-jumbo collateral. The reason that we liked it more in just the conventional collateral for the front sequential is this is shorter cash flows, and if the jumbos do heat up in terms of prepayment speeds, then you're actually going to get much lower yield, and jumbos can tend to prepay more than conventional, so we want to be kind of more in the intermediate part of the curve on a PAC structure off of jumbos and CMOs. So here's a 2% sequential. Again, loan rate 297. It's diversified servicing, 62,000 loans, and the projected speed under Bloomberg median is about a 93 basis point yield. I think a goal here, if you're looking at having to invest, is trying to pick up about a 1% spread over your excess balance account. And by looking at all these things we're talking about here so far today, you can pretty much achieve that by blending that into a yielded portfolio mix, if you will. This has about a 14% price change decline, this bond right here. Again, same bond, just looking at it on various CPR speeds. And this is where on this 2% conventional, you start getting above 15 CPR, you can really start getting yield in pretty quickly. But it's short cash flows at a very slow speed. You're still under a 6-year average life. And with this, 2 3/4 point premium, that's going to result in some yield enhancement at, if this collateral pays ultra slow. So here's the 30-year 2% using jumbo collateral now for an intermediate PAC. And I probably like this trade a little bit more than the front sequential trade right now for a couple of different reasons. One reason is you're in the intermediate part of the curve. You can see here that 5-year treasuries are 30 basis points. When I ran this today, they're about 34, 35. 2-year part of the curve, which is where those sequentials trade off, are 14. So you're getting 15 basis points of additional yield just from the curve here. The other reason why I like this is the PAC structure. You have a PAC band of 150 to 315. That means if your prepayments are within that PAC band, your average life is going to be constant, whether it's at a 115 PSA speed or 315 PSA speed. And these PACs, the thing that you need to understand is the support tranches. And the support tranches are kind of the buffer for the PAC. It's trying to keep the PAC band in place. And if prepayments are fast, the cash flows immediately go to the support tranches, and they take the pay down, and the support tranches will become very short. If prepayments are very slow, the support tranches work the opposite way. They give up the cash flows, they don't take the principal pay downs, and they redirect the principal payments to the PAC. So this PAC has the collateral here is a 294 loan rate, jumbo collateral again, so more rate sensitive than the conventionals. 17% price change plus 300, so that's a bond that will just barely pass the FMED test, but it does pass FMED. And Bloomberg median, your yield is 127. These bonds will trade about 90 in the 90s. The conventionals will trade in the high 70s spread to treasury to like perhaps maybe low 80s. So you're getting more spread here, and you're in a better curve position because you've got a 5-year average life. But on up 300, this is just a 7-year bond. So there's just a little bit more yield here. That's not to say I don't do the conventional. I'm doing both with accounts. I'm just trying to stay diversified as much as possible. Here's the 2% just on various prepayment speeds. You can see you stay above a 1% yield all the way out through 25 CPR. So this thing can pay faster, and because of the support tranches, it can hold up on yield. I'm just, for the sake of time, I'm just going to go past this slide right here. This is a way to buy 30-year collateral off of pass-through, off of Jumbo PAC with a 1.5% cut. So same type of structure, Jumbo PAC, 1.5 coupon here. So it's a way to buy down the price, but I don't like this trade quite as much. But if that, $102 price or $103 price in this bond is a little too much for you, then a way to achieve the same type of being in a pack with the 150 coupon is to strip the coupon down to by 50 basis points and lower the purchase cost. Other things that you want to look for in terms of collateral, just to sum up here, and I didn't present it here just for the sake of time, is loan balance. Less than 150K works really well, tends to hold up well. That's where all loans are less than 150,000 at origination. There's collateral out there that's state specific for states that have some, oops, lost my camera there. So that pay slower because of refinancing taxes that homeowners incur. New York is the most well known on this, along with Florida, and then investor property. And then just last, and we'll take some questions here if anyone has any questions, is a strategy that we've used a lot this year is sell bonds to the Fed, what the Fed's buying. So that means selling TBA mortgages, and we've been able to sell bonds, to the market and receive actually negative yields based upon the prices that we're receiving. So wanted to throw this open for some any questions that we may have out there.
If you have any questions, you can go ahead and type them into the chat box, and we'll get them answered if you do. Doesn't look like we have any. So you guys answered all the questions with your slides.
Fantastic.
Yeah, absolutely. Of course, Chuck and Mike have given their contact information here, so feel free to reach out to them with any questions you have, or us. We can also help you get in touch with them as well. And thank you guys so much for the presentation today. I hope that the attendees got some little nuggets of information that they can take and use at their institution. And I do want to throw in a plug for our regional meeting that's coming up on November 13th. We will have, we can't play golf with you and be in person this year, but we hope you'll join us. We have got Esther George from the Federal Reserve of Kansas City coming to speak as our keynote speaker, so we're pretty excited about hearing what she has to say. So we look forward to seeing you there. And I'll just check one more time, make sure there are no questions. It doesn't look like there are. So thanks so much for everyone's time today. Thanks, Mike and Chuck. Appreciate it.
Thank you very much, Susan. Thanks for everyone who listened in. We really appreciate it. Thanks so much.
Thank you. We'll see you next time. Thanks.
Goodbye.